The gold-silver ratio, that is the number of times that gold trades over the silver price, has tipped over the 90 times level. To put this into some sort of perspective, the average for the 20th century was 47. The average over the last 20 years is 60 and climbing, and here we are now at more than 90 times. Now, what's this mean? Well, one of the reasons for the expanding difference has been the recent rise in the price of gold, while silver stagnates. Well, joining us now from IG's Johannesburg office is IG technical analyst Shaun Murison. Shaun, welcome. Before we get to the gold-silver gap, how are you trading the price of gold at the moment?
Hi, Jeremy. Yeah, we've had a good run on gold. About 2 weeks ago, we identified this falling wedge pattern, which is highlighted with the tapering red lines on our chart, and that is just an indication that market may be setting up for a continuation of the uptrend which came before that consolidation. We were looking for a break of that red trend line at the top at about 1295 for a move, and in that breakout for a move to about 1325 and possibly 1345, using that 1275 level as our stop loss. It's worked out quite well. We've had a nice little rally. The breakout confirmed. We've reached those upside targets. And now we just see gold starting to pull back a little bit, although it is up on the day. If I just look forward here, so how would I look at trading it right now? We're respecting that long-term trend. That long-term trend is still up, but we are overbought in the short term. So what that means for us is that, well, there could be a short-term correction. We would not be trading against the uptrend or taking a short position, but rather waiting for that weakness to play out, and in which circumstance we'd be looking to try get long on gold again, and hopefully on a pullback towards about that $1,300 per ounce mark. If it was to correct a little bit further and break below that dotted trend line on our chart, we would have to reassess that longer term uptrend that's in place. But for now, long term trend is up. Short term, we could be setting up for a little correction, and we'd be looking to maybe buy into that correction.
Yeah, I want to pick up, if I can, though, on this difference between the price of gold and the price of silver. You've given us an excellent indication about this upward impetus we've had for the price of gold, and without going too much into the silver price at the moment, I think we're about $14.70 an ounce, aren't we? Which has been flatlining, comparatively speaking, which has given us this gap between the gold and silver price. First of all, what does this mean? Do we take any indications from this increasing gap?
So the gap obviously means that gold has been outperforming silver in the near term. There's been a number of catalysts. We have trade wars, safe haven demand, things like that. I mean, for gold, but historically there is a relationship between gold and silver, and over time we often expect that relationship to revert back to what is normal, to what we call a mean. I've just highlighted on a chart here that gold-silver ratio, that blue line being gold the numerator and silver the denominator, and that black line in the middle, we're looking at about 20, back to early 80s through to where we are now on that relationship. So in the shorter term, we've seen that gold outperforming silver, but in the long term, it does move in a relative sideways fashion. And like you said earlier on, you're looking at those different mean values. And for us, we think that ratio, where it's sitting at about 0.9 at the moment, over that look-back period, it's probably 0.65 or so. And obviously that mean would change depending on your look-back period for gold and silver.
So the big question is now from here is how do you trade this?
Right. So when we look at that gold-silver ratio, when it starts to move towards that 2 standard deviation mark, it's basically saying that gold is starting to become overbought relative to silver. And when we reach that sort of, and there is a pair trading opportunity some may consider from that setup, while looking at maybe taking a short position on gold against a long position on silver, and trusting that relationship will normalize over time.
But the problem is with that, though, is that you've just set us up for a long trade on gold. Does this mean then there's potentially some upside for silver, or in the short term, are we expecting that difference, that gap, to expand?
Okay, so I think this has to be seen as a completely separate strategy. If we looked at gold in isolation, we do think in the short term there's a correction coming, although we are bullish in the longer term. When we're looking at a gold-silver ratio and trading that as a pair trade, we are not really taking a directional position in the market. We are trading the relationship between these two securities. So we are trading gold relative to silver. So we take a short on gold and a long on silver in this situation, and look at the profits and losses from both positions and net them off against each other. Now, there's a number of ways that can play out. One is that we see the favorable situation from this trade scenario would be for silver to fall. For silver to gain, so we make money on our long position, and for the price of gold to fall, so we make money on our short position. And that would be what we call double alpha positive. Now, that is the ideal scenario, but it's often not the most likely scenario. What you'll find is that quite often both these securities would go up or down together. So in that situation, let's say gold and silver were both to go up. We'd want our long position to go up faster and more than our short position. So when you net off the positions, you're still profitable, but you're hedged in the market. Now, the other scenario is that gold and silver could both fall. And then what would happen there is that you would hope that your short position would fall faster and further than your long position. And then when you net off, it'd still be profitable. So there's basically three situations for this. One is that your long goes up and your short comes down. Great. The other one, profitable situation, is that your long goes up faster than your short goes up. And the third situation is that your long falls slower than your short position falls. And in all three of those situations, if that was to manifest, you'd be profitable trading the gold-silver ratio.
Okay, well, look, Shaun, we've got to leave it there, but thanks indeed for explaining all that and indeed looking at that increasing gap between gold and silver. That was Shaun Murison from our Johannesburg office.